You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right. Well, let's jump into it. I think every company in the tech sector is going to be announcing earnings this week. So we definitely want to look at one of the big players. We're going to talk a little bit about Amazon, as we usually do. And one of the interesting things about Amazon that a lot of people may not know, but Amazon, every time they announce earnings, happens to announce them on a Thursday, and it's usually after the close. So Amazon is always an interesting underlying to trade around earnings because you legitimately have a very expensive underlying, which adds a premium to the option contracts, and then you throw in the fact that they are going to be announcing earnings, and that adds premium to the option contracts. And then you throw in the fact that they announce on a Thursday after the close, and you have a one-day option contract using the nearest term expiration. In this instance, it would be the January 31st expiration. And it has all the time premium in those option contracts have to go to zero. So Amazon is always an interesting underlying to trade around earnings because of the dynamics of pricing. And as always on Options Playbook Radio, nothing's meant to really be a recommendation. We're just talking about different situations that some of the strategies mentioned in the playbook could be used. So let's go back before we jump into our trade this week. Let's go back and actually look at what happened last week. In Disney, the theme for the last couple of shows on Options Playbook Radio is what can we do while we wait for earnings to happen? And we've had a lot of earnings. We knew a lot of earnings reports are going to come out this week and next week. I think today, honestly, I heard on the news that over 40 different Dow companies announced earnings today. And the stock that we looked at a couple of weeks ago was McDonald's, and we did a strategy that was trying to take advantage of volatility coming in, some time decay leading up to earnings, and that was in McDonald's. We looked at a butterfly in McDonald's, a neutral butterfly. And this week we're going to try to accomplish the same thing with Disney. So we looked at an iron condor in Disney leading up to earnings. Earnings are going to be, right now it's anticipated February 4th that they're going to be announcing earnings in Disney. So we were going to do an iron condor this week, hoping that Disney would basically settle down going into earnings. Had a big run-up recently because of the success of Disney Plus, their online streaming platform. And what we did was an iron condor, centered around where the current stock price was at. It was at 144.01 on the day that we talked about the trade. And the strikes that we sold for the puts and the calls, we sold the 140 strike put. We bought and we sold the 148 strike call. So from 140 to 148 was the sweet spot. We went 2 points wide, so the protection on the put side was the 138, and the protection on the call side was the 150 call. We did this for a net credit of 45 cents, but that trade, we did actually get blindsided by news, and that's probably your biggest concern whenever you're doing an iron condor. We were hoping that we would have a slow news week because we're leading into earnings, and a lot of times when stocks are anticipating earnings, they just kind of slow down and wait to hear what the earnings are. But we had the outbreak of the coronavirus, and because of that, Disney actually ended up closing down some theme parks overseas, and that has caused the stock to tumble, and it tumbled pretty big. On Monday, the 27th, the stock actually closed at 135.90. So there wasn't a lot of time to get out of this trade, but I do like to kind of talk about the good ones and the bad ones as far as Options Playbook Radio is concerned. And one of my biggest things, and I always look at this when I'm doing a short put spread or a short call spread or an iron condor, which is basically a combination of both of them, is if the stock ever gets to my long strike, in other words, on any of these spreads, whatever strike that I'm buying for protection, I don't really care where the actual cost of the condor is at. If it gets to my long strike, I just want to get out of that trade. Why? Because it's an at-the-money option contract at that point in time, and you're getting a lot of bang for your buck by selling it at that moment. So I don't know exactly when Disney hit that specific strike on the put side, which would have been the 138 strike. If I look at the chart on the 24th leading into the weekend, which was a Friday, Disney on that day closed at 140.08. The low for the day was 139.20. Now, I definitely would have been out of that trade. I would not have wanted to take the weekend risk. And considering it closed at 140, I'm not quite sure where it would be at. It didn't quite hit our 138 strike, but on Monday morning it definitely did. On Monday, after the news hit about them closing down theme parks, the stock actually opened at 135.86. And if we look at the trade right now, we're taping Options Playbook Radio. It is the 29th of January. The markets are opened right now. We see Disney trading at 136.76, so it's came back a little bit, but we still have some juice in these option contracts because Disney's a fairly high-priced stock at 136.76. It's a fairly expensive stock. So our 138 put, with just a few days remaining of trading, exactly 2.5 days if you want to look at the clock here, we have 2.5 days worth of trading, and we see that the 138 strike put is trading for $1.75 on the midpoint. So I definitely want to close out of the trade. Do you want to get out? Well, it's still feasible to get out, and that long put is your only protection. So in this instance, the call side of the trade is trading for pennies, and on the put side of the trade, we could actually close this trade out for $1.60 net debit to the account. So we put the trade on for 45 cents. If you did not get out on the Friday beforehand, if you did not get out of that trade, well, at this point in time, you would have to pay $1.60 for it. You take $1.60 minus the initial net credit received, which was 45 cents. You're down $1.15 on this trade, and that basically means you fell asleep. You had the worst-case scenario, major news hit leading into this expiration date, and we did a near-term expiration because we wanted to avoid earnings. So it was almost the perfect storm, and you're still down $1.15 on the trade. You still didn't even lose the maximum. The maximum width of the spread was $2 minus that 45 cents, which would have been $1.55. So at this point in time, I think you would just close out the trade and you would move on. And what are we going to move on to? we look at Amazon. So Amazon at this moment, with the markets open and rocking, like I said, it is a Wednesday. They are going to be announcing earnings on Thursday, the 30th, after the close. So with that said, Amazon last traded at $1,862.98. Let's call it 1863. We will round up on that. We'll look at the long straddle to start with. We're going to do a long butterfly based off and pick our strikes based off of what the expected move would be. So to find the expected move, we're going to take the most at-the-money option contract, which would be the 1862.50 strike, $1,862.50. We look at buying the put and buying the call, and at the midpoint, I'm just going to round off to about $69 is about what we're looking at for an expected move. So I'd like to do if I take $69 and I actually divide it by Amazon's last trade, we're only looking for about a 4% move in Amazon because it's such a high-priced stock. So we're going to take the aspect, and you can go bearish, you can go bullish on this, you just flip a coin. Who really knows what's going to happen after earnings? You can if you have an opinion, then feel free to use it. But in general, we're just going to talk about a specific trade, and the main reason why we're putting this trade on is because of what I had mentioned at the top of the show. We have a very expensive underlying. We have a known major news event, and after that news event gets announced, we have one day that these option contracts will live before the expiration happens, which means all that time premium that is created from the news and from the price of the underlying has to go away. All right, so what's a trade that we can do that, if you're correct on your forecast, wants time premium to go away? And we're going to look at a big, wide butterfly. So if I take the current stock price, let's call it 1862, and I add the expected move onto it, which is $69, we're talking about $1,931. So let's round that off to $1,930, and that's going to be our call that we buy. So we're going to take a bullish stance. Like I said, I don't have any idea what's going to happen with Amazon, so we're just going to take the expected move, and we either go up to the first strike on the call side, or you would subtract it and you go down to the put side. That would be the concept of putting this trade on. So where the butterfly would be the January 31st expiration, which will have one day to live after earnings, and we will be buying the 1930 strike call. We're going to go up 30 points, and we're going to sell two of the 1960 strike calls, and then we're going to go another 30 points, and we're going to buy one of the 1990 strike calls. So 1930, 1960, 1990, a 30-point wide butterfly going out to the January 31st expiration. That's going to give us basically a 60-point landing strip that Amazon could be in and make this trade profitable. Basically from the 1930 strike to the 1990 strike. Now, what's the big deal? What's the determining factor here if we do this trade is you're only going to do it if you think Amazon will make more than the expected move. That's the main reason why you would put on this trade. Now, if it made double the expected move, well, then it's going to be outside the range of our butterfly. We have a 70-point expected move, and then we have a 60-point wide butterfly. So that would be double the expected move, and that would be a very aggressive move in Amazon to the upside or to the downside. So in this instance, we can do this entire trade for $2.20. Now, for example, because of the increase in volatility and because of the fact that Amazon is such an expensive stock, if you were to just buy the 1990 strike call outright, the furthest strike out on our strategy that we're looking at, you would have to pay $3.60 just for that call option. So we're doing this entire trade, we're doing this entire butterfly for less than we would pay for the 1990 strike call, which is almost 2 times the standard or the expected move away from where the current stock is trading at. So this is why butterflies are interesting in very expensive stocks, and especially ones that are going to be announcing earnings one day before the expiration of the option contracts. So here's our outlook. On Amazon, we don't necessarily know if Amazon's earnings are going to be good or are going to be bad, but we know that the pricing conditions are interesting to do a butterfly. So we flip a coin, we're going to go to the upside, and the only forecast that we're really making here is that we expect the stock to move more than the expected move. In other words, we're taking the over. We look at the long straddle. We see the long straddle is trading for about $69. We add that to the current stock price, and we determine that the first strike that we want to buy on the upside is the 1930 strike call. We then are going to sell 2 of the 1960 strike calls, and then buy our biggest hedge, the 1990 strike call. The entire trade, if we can get this off at the midpoint, would be done for $2.20, and our entire risk for the trade would be $220. This trade would last for 1 day after the earnings announcement. As a matter of fact, we're talking about this trade on a Wednesday. Ideally, the markets are open right now, but ideally we'd be looking at this trade Thursday, and we want to probably place it as close to the close as possible on that Thursday. So we really want to make this about the earnings if we're doing this trade, and based off of the information that we'd have, that would probably be our best bet at that point in time. But $220 is a fairly inexpensive trade when you consider that right now the Amazon 1990 strike call with the January 31st expiration is trading for $3.60. So butterfly on Amazon around earnings. That's going to be our trade for this week, and we'll come back next week on Options Playbook Radio, and we'll see how that trade did. We'll know, obviously, by Friday, January 31st, what happened with Amazon after they announced earnings. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.